What's up, YouTube? You've got questions?
And we've got answers. Let's get into it. The question is, what constitutes a pullback? If I want to sell a put, for example, on a pullback, how do we quantify that?
Pullback for me, I would be looking at the VIX itself. The VIX will tell you what the expectation is for a market movement. So if you have a VIX of 16, 17, 18, roughly 1% move in the market is projected up or down. If you get that 1% down move, I would call that a pullback. If it goes further than that, that would be an even better pullback to sell puts into. In individual equities, I would look at the expected move for the week. So if you've got a 10-point expected move for that week and the stock is moving 10 points, I would call that a pullback.
Hell yeah!
So the question is, sometimes Tom and Tony will say something like, they took out the weekend. What does that mean to you?
So taking out the weekend relates to extrinsic value decay. So we know theta decay is going to continuously grind that extrinsic value lower and lower. We don't know when exactly that's going to happen though. So you might see a big IV crush or extrinsic value crush on Thursday afternoon or Friday morning. And that would constitute taking out the weekend or extrinsic value related to weekend risk.
How would I go about simulating being long SPY, which is the S&P 500, or QQQ, which is the NASDAQ, in an IRA type account using LEAP options?
So if you're in an IRA account, if you buy 100 shares of stock, you have to put up the same amount of capital as if that stock were going to zero. So if we're trading SPY or the Qs, that's not necessarily practical. So we might look to use LEAP options to replicate a position like that. So what I would do is I would just try and delta match that position. So if I own 100 shares of SPY, that's 100 deltas of exposure in SPY. If I want to use a LEAP option instead, I could go in the money if I'm using long-term options and find an option that's around a 70, 80, 90 delta. The higher the delta, the more expensive it's going to be, but the higher the delta, the more it's going to be feeling like a 100 share position. So you could do one contract in the money, you could do a couple contracts out of the money and get close to that 100 delta exposure. And that's ultimately going to replicate or give a feel for 100 shares or 100 deltas of that position while putting up a fraction of the capital related to owning 100 shares of stock in an IRA account. So the question is, can you tell me what SKEW, the ticker symbol, or VVIX, the ticker symbol, is and how we can use that to enhance our trading knowledge?
So SKEW and VVIX are two interesting products. SKEW measures the out-of-the-money tail option values relative to themselves over a period of time. VVIX is the volatility of volatility. So it looks at the volatility of the options in the VIX market. And so the two of them can kind of indicate to you whether tail premium, and this is on both sides of the market in terms of the bottom, the downside and the upside, if that tail premium is expensive relative to its range. And so these two products, they're interesting to look at, especially if you are somebody that is playing for those sort of events. When those products get higher, it tells you that risk is priced higher, that there is fear in the market. But they're not directly tradable. You can't trade VVIX and you can't trade SKEW themselves. They're really just an indicator of the option market relative to tail risk. Higher SKEW, higher VVIX tells you that the pricing for tail speculation or hedging is much more expensive.
I'm new to the platform and I'm looking for trading opportunities. How do you use the platform to scan for selling premium or trading opportunities?
So in the platform, there's a number of watch lists that you can scroll through. I like to look at the high option volume list, which is in the liquidity bucket. You can also just pull up the S&P 500 stocks or even the NASDAQ stocks if you're more interested in trading those tech names. From there, you can sort those by implied volatility. You can also sort them by IV rank. Those will be good indicators of where potential opportunity might be. Those higher volatility underlyings relatively will have higher premium relative to the lower implied volatility stocks. So that'll narrow down your list to at least a couple names that you might be interested in trading in. If you've got any questions, drop them in the videos below.
Comments below.
If you've got any questions, drop them in the comments below and we'll check them out.
And don't forget, like, subscribe, and watch Tasty Live.